This is a FarmDoc Daily webinar. I'm University of Illinois Extension's Todd Gleason. I'll be your moderator for the day. Thank you for joining us. This is the Crop Risk Management for 2023 Prices, Budgets, and Risk Management Decisions. It's the second in a two-part series program. We're glad to have on hand with us today Gary Schnitkey, Nick Paulson, and Bruce Sherrick to walk us through the decisions that producers and landowners will be needing to make as it's related to crops in the state of Illinois this season. We'll begin with a few topics. Gary's going to give us some background, and then Nick will be in to talk about the commodity title choices. That's the ARC and PLC decision. And as we wrap up, Bruce Sherrick will be here to talk about crop insurance. Let's start with Gary Schnitkey. Good morning to you, Gary. Thanks for being with us. What do you have in the way of background for the day?
Yeah, thank you, Todd, and thank you for being on this webinar today. We are going to be talking about background a bit, and then commodity title choices will be covered by Nick, and finally crop insurance. I'm going to do a little bit of background, and just again, what we will be discussing today is the sort of the remaining 2023 decisions that are related to risk management, and as we're going through those, we're going to spend quite a bit of time talking about the commodity choice and the crop insurance decisions. Just to set this up a bit, we would overall suggest pre-harvest marketing more than you usually do, and that's particularly when buying products such as nitrogen. Make a commodity choice. Anyone will probably be all right, and we'll talk more about that. And then on crop insurance, most individuals are choosing RP at a high coverage level. If you're there, probably stay there. And if you have alternatives to that, think about them. But if you're at RP at a high coverage level, you're at a good place, and maybe at SCO and ECO. As further set up on just that marketing, or one other decision that you'll be looking at this year yet, and we would suggest thinking about in summer 2023, look at harvest time bids for 2024, and if we're looking at sort of $5 corn or $12 soybeans, then we might have to begin to be thinking about making adjustments. That's covered more on our first seminar if you want to, or webinar, so if you want to see that, go forward. All right, pre-harvest market more. As we're looking at this, and this is a 2018 study, and this was by corn, if we're looking at April 1, which is sort of, we're coming up to it, I guess, or our closest one, what we have typically seen is that, according to Farmer Survey, 10% of the upcoming crop is hedged by January 1, April 1, 22%, and then by July 1, 44%. And there's quite a distribution there of amount hedging, and this was a survey done back in 2018. If anything, we would be suggesting doing more this year, and that's particularly given that we've had high production cost and the potential for lower harvest prices at harvest. And while that's not a certainty that we'll have lower prices, that's sort of the worst case scenario is having bought inputs at high cost, and then selling commodities at lower prices. So that really isn't risk management, or that really isn't a price suggestion to hedge more. It's simply looking at the risks that are out there. So far, though, we've seen cash corn prices, and this is from Central Illinois, hold in there remarkably well. We're sort of been trading sideways for a while on the cash side. We're not as high as those prices that we were looking at last year at this time, but we're still over $6 for corn and 14, 15-ish for soybeans. And again, we saw those prices begin to go higher after COVID-19 pandemic, and the Russian invasion of Ukraine also had a upward spike on prices. We're still holding pretty good at cash prices. However, if we're looking at next year, and we're going to see this as we move through the month of February, The 2023 and 2024 prices, if we're looking at harvest time bids and what future prices are saying, we've lowered those for the 2023 and 2024 years. We're now at $5.30 for corn, which is still a very good price, but would be below the 21 and 2022 levels. And again, that's just based on where futures prices are now and cash bids are right now. $5.30 for corn, $13.10 for soybeans, and $7.30 for wheat. Again, based on where futures contract prices are for December delivery on corn, for example, and November delivery on soybeans. Again, those prices have declined, and we've seen some erosion of those prices during the month of February. We're showing now the February 2023 futures prices, which is the ending value throughout the month of February, which is used to set the projected price. That projected price turned out to be $5.91. And as you can see, though, the recent prices have been lower than that. And February 28, we're looking at something like $5.70. So we've seen some erosion in prices throughout the month of February. $5.91 is still roughly within a penny of last year. But the good thing that we have going this year is our volatility will be lower, and it will be 0.18. To put this in some context, and Bruce will do more of this later, that $5.91 for 2023 is a penny from $5.90. So we're still looking at a very high projected price, and you would have to go back into the 2012 and 2011 and 2012 sort of range to get comparable projected prices from 22 and 23. Again, the volatility will be 0.18. Essentially, the market is saying prices are less volatile now than they were in 2021 and 2022, which sort of makes sense. We're getting used to the Ukraine-Russia conflict, but that will have a nice impact that we will have lower crop insurance premiums for this coming year relative to last year. That 0.18 has a lower than that 0.23 will lower premiums by $4 or $5 per acre, given the same coverage level. Soybeans, again, we've seen some erosion in recent weeks, and again, that ending value is the November price throughout the month of February, and our projected price turned out to be $13.76, and our volatility was 0.13. Putting that into context, $13.76 for 2023 is lower than last year, 2022. So we're lower than last year, but still at a high projected price. So we're coming in here, and we're going to be able to provide good protection for both corn and soybeans relative to history. Again, the volatility is 0.13. Last 5 days of February determine that, and again, that's lower than last year, 0.19, and that will have an impact of lowering premiums, which is a good thing. So we will have roughly the same coverage levels as last year, lower premiums. The big change from this year and last year continue to be increases in cost, and we're having those costs continue to increase into 2023. The reason why we're projecting increasing cost in 2023 is because last year there was some chance of buying particularly fertilizer at lower price levels. Coming then, we can look at what minimum price guarantees look like and just make a comparison here. So I'm going to start here. I'm going to put non-land cost and cash rents at the top, $8.58 for corn, $3.41 for cash rent, soybeans at $5.32, and our total cost coming in at that $11.99 for corn, $8.73 for soybeans. We have a trend-adjusted yield of 230 for corn and 72 for soybeans, which is pretty typical for many areas of high productivity land in central Illinois. Use our projected prices and then subtract a basis, because I'm translating this not into a crop insurance guarantee, but a cash guarantee near harvest. If you look at that, we're going to come in there with a cash guarantee, 30-cent basis, 1101 for 85% coverage level, 861 for soybeans. And that is a little bit below our total cost, but still, that's better than having a couple $100 there below that, which was happening in 2016 through 2019. So if we can continue to take coverage levels at pretty high at high coverage levels, particularly RP, we will see those. All right. Bruce will be talking about crop insurance a little bit later on, and we will be looking at these various products. RP, revenue protection, which is where most of these are at. RP with harvest price exclusion, which hardly anybody takes. YP, yield protection, all of those are combo products. Again, most people take RP, and then we have the county level products. ARP, which is a revenue protection at the county level, ARP, HPE, and AYP. Again, if we look at what most farmers have done in the past, and this is for corn, this was from 2022. 94% of our acres were insured with RP, 34% at 85% coverage level, 38% at 80% coverage level, and 16% at a 75% coverage level. Again, we see people staying there or being there, and if you look at it, Southern Illinois farmers tend to be in the 75 to 80% range, and Northern and Central Illinois farmers tend to be in the 85 to 80% range. Staying there, if you're thinking about staying there, that's probably a good place to be. We also have 3% of our acres in margin protection. 11% of these acres that are in RP in particular use supplemental coverage option, and 6% had enhanced coverage option. So what we see farmers doing is saying the preferred crop insurance policy of most farmers is RP. We see them taking trend adjustment at high coverage levels. If you're there and thinking, I see no reason to change, stay there. You may think about adding SCO and ECO. And actually, we did have a question about SCO and ECO. And to state it quite simply, thinking about soybeans, should I use SCO and ECO? And what do I give up by using SCO and ECO on soybeans? I'm showing premiums here, and Bruce will go over these tools a bit later, but I'm showing premiums here for a Piatt County case. And let's say you're at 85% RP. That is a $975 per acre premium. And I'm presuming that the question, what do I give up by going to SCO and ECO, is under the impression that you're going to be moving down the coverage level. One thing that I would point out is you don't have to give up anything except more premium dollars. You could buy ECO, for example, at 90% for going up from $975 up to $1,730, and that would get you SCO and ECO 90%. So you could do that. Many people think about lowering the coverage level on RP and keeping that premium at $1,472, for example. So what do you give up? And let's just remember what supplemental coverage option and enhanced coverage option is. So we have RP at a coverage level below that, and that's a farm level product. Supplemental coverage is a county level product, and it goes from 86% down to the level of RP policy. You have to use price loss coverage to have SCO, which may dictate some of your commodity title choices, and it's eligible for any combo product, and it mimics the underlying combo product. So if you buy RP, SCO will have a guarantee increase in it. If we look at enhanced coverage option, it's a coverage level above SCO. It can go from 90 to 95% down to 86%. It can be used with or without SCO. So you don't have to buy that 86% coverage. You could just buy ECO, and it can be used regardless of commodity title choice. So what do you gain and what do you lose? So I'm going to say, take this example. Suppose you drop from 85% RP to RP 80% plus SCO and ECO 90%. The advantage is, I guess, or the change is that you get county coverage from 90% to 80%, given my example, which would, if the harvest price is less than the projected price, we would have county coverage from a band on top of that. That would give us a higher chance of a payment and a payout because you're raising the coverage level, in particular the price side of it. Here's the disadvantages. You lower the farm coverage from 85 to 80, and that can result in lower payments if your farm has a yield loss and the county does it. It will reduce your prevent plant payments, and it will increase your farmer paid premium costs. So those are the trade-offs. And one can make an argument either way. Either way you go, you can make a good argument for using that alternative. Finally, just one thing to keep in mind is that we've had disaster assistance programs from 2021 backwards. And that's been in place since 2018, and that's WIP Plus, and ERP. What those programs do is increase the coverage level of crop insurance and non-crop insurance disaster assistance policies. So if you had bought 80 to 85% on your RP policy, it would increase your coverage level under WIP or ERP to 90%. And if you had bought SCO under WIP, it would have increased it to 95%. What happens in ECO and in ERP with those situations is sort of open questions. Those may not exist for 2023. They could, they couldn't, but there's been a situation where they have existed in the past, and if they would exist in 2023, buying an 80% coverage level versus an 85% coverage would have limited value. So, got to keep that in mind in the background, and that may have some influence on your choices here. With that, we'll turn this over to Nick, and he will talk more specifically about the commodity title choices.
All right, thanks, Gary. Big picture overview of the commodity title choices. Again, just to clarify, we are kind of switching gears here and going to focus on the ARC PLC decision, and then what we're going to talk about in the next few minutes is going to focus on specifically ARC County versus PLC comparisons. Obviously, there's also the farm level version of ARC. I mentioned that a few times, but something you can, very, very individual choice if you're thinking about ARC IC, and we've Gary's put together a lot of analysis tools available on the FarmDoc websites that you can take a look at that more carefully if that's something you want to consider. We're going to focus on ARC County and PLC. Have until the March 15th deadline this year to make changes if you wish to do so, and choose those programs for your FSA farms and the base acres on those FSA farms. So again, just big picture stuff on the commodity title choice this year. As Gary pointed out early on when he started out this morning, this isn't a make or break decision this year. Probably not something to spend a lot of effort on. Payments are just not likely on corn, soybean, or wheat base from either program. I've probably spend too much time on Twitter, and you may hear things from sources like that about Ark County having a higher likelihood of triggering payments. Technically, that is true because they can be driven by yield losses, and just given where price levels is, it's probably more likely we'd see a revenue loss because of yield losses this year rather than a price decline. But the caveat to that statement is we're talking about maybe a 1% chance of an Ark County payment versus a less than 1% chance of a PLC payment. So, it's technically that's correct that Ark County might be more likely to trigger higher expected payment from that program this year. But again, it's the comparison here is very very similar. So what should you consider in making this decision? Well, as always, what type of risk concerns you most? Are you worried about significant price declines from where current price levels are at? And then also, or are you more concerned with, or are you in a situation where your farm, the county you're in, is one that might be subject to a higher likelihood of a yield decline? That's probably going to drive this decision this year. And then second, the linkage with the crop insurance choices here, again, as Gary pointed out, if you want to use SCO on any acres, those need to be enrolled in the PLC program for you to be eligible to do so. You can use ECO on anything, but SCO specifically does require those acres to be enrolled in PLC. Ark County or Ark individual acres are not eligible for that SCO coverage. So again, the decision deadline is March 15th. We're still in that window from the 2018 Farm Bill. We went to a annual decision on this. So this potentially could be the last year you're making a decision just for one crop year, but that's the situation we're in for 2023. Again, just a reminder to people, you can mix and match these programs across farms and across commodities. So, you might have example here, if you have 2 FSA farms, you have corn and bean base on both of those FSA farms. You could put corn and FSA Farm 1 into PLC, corn and the corn base in Farm 2 into Ark County. You could put your corn base in Farm 1 in PLC, soybean base in Farm 1 in Ark County, or you could put everything in the same program. So you can mix and match across your farms, mix and match across the commodities when you're looking at PLC in Ark County. If you are looking at Ark individual, again, an important thing to understand about that is if you enroll any base on a farm in Ark individual, you're enrolling all of the base on that farm in Ark individual. So less flexibility in terms of mixing and matching if you're looking at Ark individual. So, what's driving this very low likelihood of payments from any of these programs? So I've got a picture here for corn, very similar picture for soybeans and wheat coming up. And what I'm showing here is the orange series is the marketing year average price for corn going back to 2017. So 17, 18, 19, 20, and 21 marketing years are finalized. The 2022 is still a projection from the latest WASDE report in February. And then the 2023 price is that 530 that Gary had in his slide. That's kind of our projection based on futures and cash markets right now for what we think 2023 marketing year average could be. And so you can see that we moved out of a period of lower marketing year average prices from about 2014 to 2019. Marketing year average prices have been climbing since that 2019 marketing year, and we're just now seeing the impact of that on the Ark benchmark. Again, because of the way that Ark program sets its benchmark price, it's based on the last 5 finalized years for the current marketing year. So for 2023, that means that the 2017 to 2021 period is the 5 years that go into that Ark benchmark price calculation. And we're just now getting to the point where we have enough high prices in that history or higher prices in that history to pull that Ark benchmark up above the effective reference price of 370, which is the relevant price for that PLC program. The other thing I've got in this chart is what I'm calling the Ark trigger. This is something that Gary's written articles about the last few years. Basically what that is 86% of the Ark benchmark price. That would be the price at which Ark County payments would be triggered if your county came in with a benchmark yield level right at expectation. And so, the effective price coverage under ARC is really still lower than what we see for the PLC program. But again, main takeaway here is even though we're expecting a decline in marking year average price in 2023 relative to 2022, we're still well above the price protection side of either the PLC or the ARC County or ARC IC programs. And so we would need, significant declines even from where we are currently seeing expectations for these programs to trigger payments on any of these main commodities here important in the Midwest. Similar story for soybeans. Again, last 3 years coming out of a lower price environment, back down a bit in 2023, but just now starting to see that our benchmark price get pulled back above the effective reference price for PLC. But even the ARC trigger for soybeans is still just below that 840 price. Again, the big gap between price expectations and the price coverage for ARC or PLC there. And really the same thing for wheat. Wheat, the gap between the marking year average expectation of 730 and that 550 reference price, wheat is arguably the crop where we'd see the highest chance of a marking year average price get low enough to trigger a PLC payment. But again, we're talking very, very low chances, low probabilities of anything like that occurring. And honestly, if we're seeing price declines at that level, ARC and PLC payments are probably not going to be our priority. Probably have a bigger issues we're looking at. I would honestly expect some more ad hoc assistance to come in if we were looking at situations where we get into price levels that would trigger payments from either one of these programs. I also wanted to highlight some of the scenario analysis and that you can do if you're kind of trying to get your head around how these programs work. So this is a table that it comes from the Excel version of the ARC County PLC decision tools that are available on the farmdoc website. The link there is at the bottom of the slide to get to this spreadsheet tool directly. And so what these tables show is a comparison of, or the difference between PLC payments and ARC County payments for different market year average price levels across the columns on the top, and at different county yield levels along the rows there on the left. And so this table is kind of centered at a 450 corn price and a 220 bushel yield, and then looking at prices and yields both above and below that. The one thing I would point out here is we've even lowered the midpoint of the price range we're looking at here well below where we think corn price is going to be. Again, we're looking at probably a 530 price. Here we're looking at move the price levels down so we could see lower prices that would be needed to trigger some payments here. So the takeaway from this, far left towards the top of the table, you see $68 payment at a 325 price, $30 payment at a 350 price. Those are kind of the neighborhood of what PLC payments could be. At those high yields, very low price levels, we'd see potentially some large PLC payments. Again, you can argue about how likely it is we'd see corn go to 325. I don't think very likely this year. And then as you move down, again, in the left portion of that table to some of those red cells, that's where we see the scenarios where our county would provide a bigger payment. And PLC is not triggering anything at a price above 370, but kind of those very low yield, very low price scenarios where our county would trigger the larger payment. Again, not likely that we'd find ourselves in those situations, but that is the ranges where these programs would start to trigger payments. Also wanted to highlight our web-based ARC PLC tool. Again, this is there's some pretty involved probabilistic modeling going on behind the scenes here. This is in partnership with the National Center for Supercomputing Applications. I want to draw attention to the bottom row of the results table there. And so this is just kind of a estimate of what we'd be looking at in terms of likelihood and expected payment levels from these programs in Champaign County for corn. These are based on a 540 price, which is 10 cents above the 530 we were talking about earlier, but in that range. And you can see there that, there's technically probably never a 0% chance of a payment, but, we're effectively at a very, very low likelihood of seeing support from either one of these programs in 2023. And yes, Ark County does have a higher expected payment, but again, we're comparing 15 cents here to effectively zero for PLC. Again, back to that spreadsheet comparison table. Again, for soybeans, the price range we're looking at here is even much lower than what we would expect. The entire range of price scenarios here doesn't even get into that $13 price we expect for the year. But low prices, high yields, very low prices, high yields is where we might just start to see PLC payments. We got to get below 840, and then very low yields and honestly low prices would be needed, lower than expected prices at least would be needed to see our county payments, the areas in red in the table. And then finally, same story for wheat. So we need to get below that 550 range for PLC payments there at the far left. And really yields that would be significantly below expected yield levels. This again happens to be for Champaign County, just as an example, but really very low yields and even lower than expected prices before Ark County would really start to trigger much in the way of payments as well. So again, the commodity title choice, not something we need to worry, I think, too much about. It's not a painstaking choice. Probably the biggest factor is, again, what you're worried about and what your crop insurance preferences might be. And with that, I'll turn it over to Bruce to talk about crop insurance.
Thanks, Nick. Well, good morning, everyone. Thanks for joining us. As you know, we're now into the sales period, the active sales period for crop insurance. So the next couple of weeks will be when all of these decisions have to be made. And what we want to do in the next few minutes is just talk about some of the tools we have to support that decision, some of the conditions that we find ourselves in, what that suggests for the general direction of the decisions and how they will kind of add up. And excuse me, then get into some Q&A around this. We've got some great questions that have already rolled in around crop insurance. Keep typing those in and we'll try to get to those. There we go. I wanted to start with just kind of like the flyover at the beginning of the Super Bowl with all the fighter pilots. We have developed quite a set of tools really that we offer at the farmdoc website. And the crop insurance tools include quite a few things that go all the way from county representative to own individual premium calculators to tests of what the likelihood of payments would be, to real-time estimates of the probability of prices changing between now and the end of the crop period, and so on and so forth. We just wanted to bring attention to that. These have been developed through a long period of time in cooperation with some of our supporters, and if you have other ideas of tools that you think would be really valuable, please let us know, and we try to be very responsive to that. I want to start with, I'm not getting my clicker, there we go. Kind of a recap. I know this is a little redundant with information that was provided earlier, but I want to talk about one particular relationship here that's presented. If we were to look at the projected and harvest prices through time and the volatility, I want to make a particular point that it's, in a sense, the volatility per unit of price that determines how much coverage and how much coverage costs per dollar of expected revenue. So when we were, pardon me for my voice today, when we had in, say, 2020 for corn, a 15 volatility, and volatility is a measure of the variance or the standard deviation around the price. 15 cents out of 388 is a relatively higher riskiness than 18 cents out of 591. And so one way to think about the cost of insurance is how much that part of the calculation of the premium is tied to the underlying futures prices. The other really important thing to recognize is that, as Gary's graph showed, we've had futures prices retreat a bit, but the projected price is calculated as the average of the ending prices by day in the month of February for the December contract for corn and the November contract for soybeans. Again, sorry for my voice. Very critically, RMA's crop insurance premiums do not depend on the difference. That is the gap between projected prices and what you could begin making your marketing decisions or hedges at relative to the current futures prices. So take a stylized example that mimics this year to some degree and say projected prices are 10 to 20 cents above the current futures price. What that does to available coverage is one of the things we want to talk about, and it responds in some sense to one of the questions that's already been typed in. Given that the projected prices are already above the current futures prices, it makes it harder for harvest prices to be higher than spring starting projected prices, because not only do they have to go up by whatever the current gap is between the projected price and the futures prices. This provides something that you could think of as an in-the-money put, in a sense. You can already lock in a price that's higher than you could if you could go into the futures markets and market directly. So that benefit doesn't cost more this year. If we had had a year, which we have had, about half the years are the opposite of this effect. If we'd had a year where the current futures prices were quite a bit above the current projected prices, you have a different kind of effect where you can go ahead and market against your crop insurance premium. And again, lock in that difference right away. So either direction, the greater the gap between the projected price and the current underlying futures prices can be an advantage to selecting coverage. You just have to match it up with your marketing. A couple of other questions that have come in. What does the recent break in prices do to your insurance choice? And we'll kind of walk through that in a little bit more careful fashion than just saying, well, it created, a benefit in some sense to taking higher coverage insurance because you're getting some extra insurance for not an extra premium at a higher price. But we want to walk through that a little bit more carefully. The tools that we tend to focus on for this are the 3 crop insurance direct tools that have most relevance between March 1 and March 15th after the projected prices are determined. Just showing you icons of what you'll find at our crop insurance decision tool site. The payment evaluator is the one I'll focus on for the next few minutes, but we also have a premium calculator so that you can, in real time, put in your own farm situation and figure out what premiums would be. Again, we want you to make sure you talk to a qualified crop insurance salesman before the final choices are made. But this is a really good, really quick way to get a rapid understanding of the relative costs of insurance. And then we'll talk about as Nick said, there's some fairly extensive modeling behind the scenes here to talk about how each of those crop insurance products would perform. The third tool is always live, but I think it's especially valuable during the crop insurance sign-up period. The price distribution tool, as a little bit of an advertisement, just goes out and when you click on it, grabs the current futures and options prices, the entire complex actually, out of the traded set, and determines the likelihood implied by the prices people are paying for puts and calls of prices changing by a certain amount. So if a put gets very expensive, you can believe that people think the likelihood of a price decline must be higher. If a put were really cheap, they would think it would be less likely. And therefore, you can use that actual set of market prices to determine what the, if you would say, fair cost of insuring against price changes should be. And the fair cost of insuring against price changes coupled with your yield distribution is really the background to how we evaluate federal crop insurance programs. So I'll dive into those a little bit here. Excuse me. The crop insurance payment evaluator to start. Thanks, Gary. We're all in a small studio here sharing the mouse and the keyboard that associates with our screen. So we're sorry for a little banging around noise that I've been making here. The 2023 Crop Insurance Payment Evaluator is just a tool where you can go in and with one case farm per county, examine how each of the different insurance products would affect the likelihood of different final revenues that you would have with insurance, without insurance, with different coverage levels, with combinations. We can think about that as being like the most prototypical case in every county, and then you can dial in your own information inside the premium calculator if you want to get a little bit more customized, or a lot of companies have add-ons to the underlying federal product that does something similar. Okay, so in this case, I'm going to look at Champaign County for 2023. We did this one last year. Just to kind of orient you to the tool, when you access it online, you'll see that there's a case farm information, an insurance evaluator tab, and a revenue risk tab for all of the states that we include, all of the counties by state, and for corn and soybeans. We don't do this yet for wheat or sugar beets or sorghum or cotton or rice. Those are additions we're contemplating, but the vast majority of crop insurance premiums are actually still corn and soybeans. Wheat would be third. And so we focused on the big crops and are beginning to add more capacity as we go forward. In the case farm here, we're looking at around a 200 bushel average, or 197 in Champaign County. The farm standard deviation of yield, or the riskiness, 38.2. The county average, only 30. And this is a really critical piece of information to interpret, and it helps explain the difference between payments in SCO and ECO against the farm underlying payments. To do that, I'll hop over to the right-hand side set of columns there and just say the farm yield and county yield in bushel per acre with those 30, 20, 10, and 5% kind of benchmarks. Given that we standardized this to be the typical farm in a county, call it around 200, the farm yield will vary by more than the county yield will. So your yield 1 in 3 times, roughly, or 30% of the time, would be below 178. At the county, that would only be 183. And so it will take more to trigger. It'd take a worse outcome at the county to trigger the same effect at your farm. Another way to think about this is you're less likely to get the county's payment than you are to get your own for a same number of bushel decline. Another way we try to talk to people about is to say, well, how correlated are your yields to the counties? It's not that they're both 197. It's if your yields go down 10 bushel when your county yields go down 10, and your yields go up 10 when your county yields go up 10. The more that that statement is true, the better the county or group products perform in ensuring your own risk. So just to continue with this example, given the starting position, we think very consistent with Gary's slides, about 1,036 gross revenue. Thanks. Well, and this first table that you would see as you go down just repeats the premiums per acre. So I'll just kind of point at the columns here. Under RP, and then the next block is RP with HPE, and the next block is YP, and below on the page, if we could display it all, would be the county products. But to start with, the premium per acre, $1.44 for 50%, up to around $38 for 85% coverage. That's the farmer paid premium. We can calculate with a reasonable degree of accuracy what would happen if we were to repeat this case a very large number of times. So the average payment per acre, if we were to repeat the conditions that we had going into this year, same prices, same price distribution, yield distribution, repeat that literally millions of times, we would get a 106 average at the 50% coverage level, a $61 payment. We can calculate the number of times it was not zero. So 39% of the time with 85% coverage, the combination of the correlated yields and prices would give you at least a positive payment. And the way to interpret this next column, which I think is the most important column, is that the net cost of insurance is that RP on average over a large number of years for corn in Champaign County would be expected to pay back $23 more than the premium you paid. Now, again, this is because it's federally subsidized. It's meant to have a loss ratio that's close to 1. Corn has not reached that loss ratio on average through time. Neither has soybeans, but the subsidy is still greater than the overrating or the overcharge. And in that case, you still get $23 more per acre than you pay on average. And we do have to adjust very carefully. If you were to do this analysis for the effective loss ratio, you can't just say payments targeting a 1.0 loss ratio mean that the subsidy you get translates directly to farm subsidy. I think that's a point that's often missed, and frankly often missed in the narratives of public press and popular press. Moving block by block, RP with HPE, you would see, in a sense, we identify, and in this case, it's important to remember what we said a few minutes ago, that the current futures prices are below the initial insurance price. That fact takes away a bit of the advantage for RP, because the starting insurance price, you can think of it as your guaranteed minimum threshold, is already above the futures price. So it takes a greater price movement in the underlying to create a revenue increase that would happen with RP's harvest price provision at the end of the year. That just makes HP relatively cheaper. The premiums you see are quite a bit cheaper at 85% coverage level, 38 versus 2166. And a lot of that translates to increased benefit to the farmer, even though the payment frequency declines from 39 to 33%. The net cost of insurance is $25. So this means that the choice, and why it's hard to answer the question, changes in prices, does that affect your insurance choice? It depends very critically on what your risk tolerance and capacity to bear risk would be. In a highly financially stable situation, you might favor some of the area products because they pay back on average, both empirically, I mean, we can see this in the history, and in our model effect, they pay back even more, but they don't necessarily pay in the years that you need it. So if you're using insurance to make sure that you don't have a negative total outcome in a given year, RP tends to be the best choice. And again, what we have observed time and time again is that the farmers are the smartest people in the room. The observation of what's most commonly used by farmers is actually a pretty good piece of guidance on which is the best product to take. YP, there are situations where if you have a good way of managing your price risk, YP may be a very attractive item. Some of the private market products also let you, in a sense, insure RPs separately or add on an RP protection over top of an underlying. So sometimes RP, again, just if you're worried about the yield decline and not so worried about your price decline because of marketing activities or other ways of managing that, YP can be a very attractive policy. Questions come in on drop in input costs relative to margin protection. We'll maybe hold that one a little bit for the Q&A. Margin protection, from my perspective, and this is very editorial, MP doesn't really reflect changes in the farm level, changes in costs very well at all. We've tracked that very carefully. So it's set up to be a standardized farm, but if you have different amounts of interest expense or margin, you pre-priced your diesel, or you have no-till versus a 3-pass system, it just turns out that it's not highly correlated. So we can talk about that a little bit more going forward. But again, I think the farmers are the smartest folks in the room. You see very low usage of the product, and it's, a couple of years it's had good payments, a couple of years it's not at all, and on average it's exactly what you would expect it to do. So would you say that ECO and SCO are more attractive than margin? Again, I think it depends very much on the relationship between your yields and the county yields, whether ECO and SCO make any sense at all. ECO and SCO can get kind of pricey in some areas, can be relatively cheaper in other areas. So I think the pricing surface, if you will, for ECO and SCO is a little less well calibrated to the actual risk, is kind of how I would describe it. And a crop insurance agent is probably pretty well keyed into whether or not the county you're in, this makes a lot of sense, or whether it doesn't. Real quickly, just moving on to the next version of this, and just to show the county level products, Gary touched on the ARP area revenue protection and ARP with harvest price exclusion, and also AYP. Again, if I were personally in a situation where I had a very large set of operations spread all over the county, there are arguments that I could make where I would take actually AYP because it's a relatively cheaper premium. I may have a mechanism to ensure my prices right now that's relatively cheap, and then I'm in a very effective way insured against major changes in yield. If we had a major drought this summer, for example, and yield was the main problem and prices went up, we can think of the RP may not have paid because of the negative relationship between prices and yields, but then YP would have changed. Moving on a little bit more, just if you go to the third tab then, you remember early on the screen, I think I may have missed the copy of this, but when we go from the case farm to the evaluator to the revenue risk section, one of the things it provides is a nice interactive graph so that you can compare how revenue risk by product choice influences the likelihood of you achieving some target revenue. And you can just type that in actually too. You can go into the tool and say, I need $1,000 an acre. What's my chance of getting it? And so this is one of those examples where you could look at no insurance, 46% of the time, you wouldn't reach that. You can kind of look at the left-hand scale, and let's just focus on 10%, for example. 10% of the time with no insurance, you'd be below 728, for example. To get to 10% with ARP HPE 90, you would be 1,017. What's attractive about RP, though, and just to be clear, the other products have the corresponding relationships in between. What's attractive about RP85 is the degree to which it really cuts off the left tail. So the individual revenue products, which reflect changes in either your own yield or the available price, do a really nice job of limiting the downside tail. So even though some of the other products, area products in particular, pay more on average, they don't necessarily pay when you need it for a really dire outcome. Again, the distinction this year, this is a modeled outcome for one specific farm. We have some specific assumptions about the correlation between county and farm by county. They're very high in Champaign and McLean and Central Illinois. They're lower as you get to other regions of the Corn Belt. But that somewhat drives the area results. Moving on to the last tool really quickly, just saving a little time for Q&A. This is a really interesting, effort that we've developed over a long period of time, and it turns out to work pretty well. We've, pretty proud of the fact that it's pretty calibrated to actually what happens. If you were to run this every day and then archive it and then look backwards through time and say how accurate was it, it turns out that it's got the same effects that market participants have, and that's that people who are betting their own money are pretty good about figuring out the odds. So in the one that we'll kind of focus on here, just give an example, did this last night, looked at the insurance price of $591. And again, this is as of last night. So again, haven't checked markets closely this morning. But if we were to just literally type that in, it said the market participants believe there's a 61% chance that prices will be below the current insurance price. Now, remember, futures prices are below $591 right now. 50% of the time, the price expected for December would be below $558. You can see the tabulation on the table on the right. Again, explaining Nick's results in a completely different way with exactly the same answer. There's just not much chance of getting to a price level to trigger. There's 5% chance of being below 406. So it's just hard to get down to a low enough price that you're going to create a combination of outcomes to trigger ARC and PLC. Go to the next one for, excuse me, soybeans again at the current insurance price. Again, we get a similar kind of effect, not quite as much of a difference, partly because the width or the bandwidth of that price distribution, it's easier to get a buck change in soybeans than it is to get a buck change in corn, because a buck against 13 something or 14 something is not nearly as big of a percentage change as 1/6 would be in the sense of corn. But again, I think the important thing is to say there's a chance of, 5-10% chance of being over 15 or 16 bucks, and a 5 or 10% chance of being below about 11 to 10. So I think this is a nice way of figuring out and deciding when and how to lock in some of the lower limiting prices. A couple other things to remember about crop insurance: final planting date. We often think about that as the beginning of, excuse me for that, the beginning of June for much of Illinois for corn. Split a little differently, as show a picture in the next one. And then after the final planting date for full insurance, you can continue to plant. You just lose a percentage of your guarantee each day. And after the very end, you can still do things, and depending some years on the legislative response or the rule-based response. 2019 was a very specifically sort of strange year because of the extra prevent plant we had. But again, you can think about it as getting kind of a 60% chance or 60% payment of what your original claim would have been. Afterward, if you continue to plant, you can still prevent, plant, you can still capture the prevent plant payment, but at a lower 35% of the original amount. A couple of charts. Gary's put together some great details about this in prior Farm Doc daily posts, just displaying when those dates happen and what part of the county. And if you're in another state, the same resources exist. We can look where those from south to north expected planting date and end of the period of time where it would be expected that there would not be a significant effect on yields. When that happens after that date, that's considered the late planting date. With that, I think we'll stop and go to a kind of Q&A.
All right, good, Joe.
You bet. We'll do that, and we'll get to the questions. If you've got some, go ahead and put those into those gray boxes over on the left-hand side of the page or down at the bottom of the page, and we'll get those collected and answer them over the next 5 or 6 minutes here. We do want to thank our sponsors for the Farm Doc daily webinars and the website both. They include the TIA Center for Farmland Research. That's farmland.illinois.edu. The director of that particular operation here on campus, of course, is Bruce Sherrick that you just heard. Compere Financial, Corteva Agriscience also helping out, along with Farm Credit Illinois, the Illinois Corn Growers, and the Illinois Soybean Association, and FS Growmark. Our educational partners include FBFM, that's the Farm Business Farm Management folks, the record-keeping service in the state, along with University of Illinois Extension and the Department of Agricultural and Consumer Economics. Of course, there are some other things. We also want to thank you for joining us. This webinar will be archived at the Farm Doc Daily website, farmdocdaily.illinois.edu, and you can always check it out in YouTube, youtube.com/@farmdoc. Now, Gary and Nick and Bruce, are there questions that we need to take care of yet for the day?
So we have a couple here that were submitted, and actually a couple of these are from before the webinar, but one is, what's the best way to cover soybeans other than straight YP economically? And I'm assuming if you're going to YP at coverage levels, you're wanting your premium to be relatively low. That is a good alternative. I would suggest if you're going to be doing that, you're going to be doing some more price protection on the price side. So if you want to protect your soybeans using futures and options contracts or forward sales, YP would be a good alternative. If you're not going to do that, I would also suggest that you look at revenue protection with harvest price exclusion. So you might think of doing the revenue protection with harvest price exclusion if you're concerned about economic or lower premium. Once you do that, you have to be careful on the marketing side. So there you go. Another question. You went through your reasoning for recommendation for high-level RP coverage for corn. Does the same apply for soybeans? And here's the gist of this question, I think, is we've had very low loss ratios for soybeans in forever. And should we be lowering the coverage level from 85 to 80 and maybe down further? I frankly have a hard time saying that because, the minute you do that, something blows up in the world. So the recommendations probably would still stay the same. Nick, Nick's looking here. He was sitting back quietly. I decided to ruffle his head.
No, I mean, I think, crop insurance is such a unique thing. As we talk about this with students and, because it's subsidized, and this sort of gets that question that just came in even in the last minute about the fact that crop insurance is subsidized. And, even, as Bruce said, even if you want to make the argument that the rates may be a bit too high in the Midwest, at least based on history, again, there's arguments for and against that. But even if the rates are a bit high with the subsidy, isn't it in your best interest to buy that subsidized lottery ticket because there is an expected positive payoff through time? That way of thinking about crop insurance is sort of the, what I call like the expected return, profit maximizing view. But, crop insurance is one of the only insurance markets I'm aware of where people think about it that way at all. I mean, we don't, every other insurance we buy, we don't want it to pay off. And so, and we willingly pay more than we expect or hope to get back out of it over time for that risk management coverage. So kind of segueing into my point here is that it's from a risk management standpoint, I think it's hard to recommend reducing coverage in any year. And I would say, in particular in a year like this, where we've got, again, forecasted profitability that looks okay, but I think, even more downside price risk and, even volatility on the remaining input cost side that I just think makes it hard from a risk management standpoint to justify reducing coverage.
So we got two more questions here we'll take. Given that crop insurance is heavily subsidized by the government, would it not be in the interest of the farmer over the long term to take high levels of protection every year? And the answer to that one is yes. And that's what we see farmers doing with that RP 85, 80, and 85, 75% coverage levels. Shallow loss programs are very significant problems for most farmers, and yes, I would agree with that. Shouldn't that cause farmers to go up to 90 or 95 level with ECO and SCO? So, and here's what I will say about that. One of the things that we observe about farmers is that there's a limit that they will pay on crop insurance premiums, and that typically is in the 15, 20, 25, maybe more than that. That area. ECO and SCO are significant expenses, and given the subsidies involved, you would expect ECO and SCO to pay out more than you pay in. So there is that incentive, but then when you begin to look at the cost of the premium, it does significantly reduce profits in those years in which you don't have a payment.
I would just add that none of the crop insurance products exactly mimic what a farmer does with their actual crop. And so if the crop were literally turned over to the insurance program in lieu of the other payments, and then you added exactly marketed at the time of the insurance termination payment, then you would expect to pick up the subsidy through time. But farmers store, farmers pre-market, farmers have other engagements with pricing and in fact even yield risk through time, that I would say crop insurance is a 1 year at a time program, but farming is not. And thinking about that through time means that the correlation between the payments from ECO and SCO are not super high with the actual revenue. And so I agree with the implication of the question completely, that the subsidized dollars should be bought. If you can buy a dollar for 79 cents, you should buy all of them you can. But there are timing impacts, and there are issues that break the correspondence between that and the actual risk protection afforded by the use of the products.
So don't farmers have very different risk profiles if they are heavily marketed versus unmarketed going into a year? That is true.
Yes.
Yes, that is true. Shouldn't the farmer's crop insurance depend heavily upon their current planned marketing positions in going into the marketing year? So
I think I think you could look at it, one causes the other or the other causes the other. I think it's a joint decision. It's again, part of the overall risk management strategy, how you market and how you line that up with your crop insurance choices. The academic research in this area, which I think all three of us have been involved with, would say that one of the things that the introduction of the guarantee increase that RP provides is it allows farmers to be more aggressive on marketing if they want to, because it protects you from those short crop, high price years where aggressive marketing could get you in trouble.
yeah, so the more aggressive you're marketing, the more you should take RP. And many people that aren't in aggressive marketers still take RP because there's a high chance of payment in those drought years. So yes, you're right. More you market, the more you should lean to RP. And with that,
I'll let Todd take us out.
Indeed, we'll close things out for this webinar. Thank you for joining us today. We do appreciate that. Remember, it is archived at the FarmDoc Daily website, farmdocdaily.illinois.edu, along with all of the rest of our webinars. We do want to thank Jim Baltz, who's behind the scenes. Jim, of course, the technical director for the day and making sure everything works properly. Our panelists for the day have included Nick Paulson, Gary Schnitkey, and Bruce Sherrick, all agricultural economists here on the Urbana-Champaign campus of the U of I. I'm University of Illinois Extension's Todd Gleason, thanking you for joining us today.